Okay, welcome everybody to today's webinar on understanding lending opportunities. I'm Olivia McCormick. I'm the Senior Education Coordinator here at Case Credit Union. And today we have special guest joining us, Laura Hosey, who is our Vice President of Lending. So welcome, Laura. Thank you for joining us.
Thank you for having me.
So we are so excited to bring this to you guys today. So we will get started. So during today's webinar, we're going to cover a lot of material. We're going to talk about loan definitions. We're going to break down each kind of loan you can possibly receive and what those look like. We're going to learn which loan is possibly best for you if you're somebody who's looking for a lending opportunity. We're going to talk about the impact of interest if you were to take out a loan and knowing the terms of a loan, which is extremely important, and then how your credit can impact any kind of loan consideration. Credit is extremely important in every aspect when it comes to finances. So questions can be asked at any time using the Q&A feature of this Zoom webinar. We'll have breaks throughout the webinar where you'll see this exact slide pop up and you can add your questions to the Q&A section. But please note that all questions are viewable or discussable by all attendees. So we want to make sure that if you have anything personal that you want to discuss, please reach out. My email is on the screen. I will get you to the appropriate person if it is not myself, and we will get those questions answered for you. But general questions can be asked in the Q&A feature today. So before we break down lending opportunities, we want to kind of break down credit unions versus banks. So credit unions and banks are similar, but they're also different. So credit unions are not for-profit, meaning that our fees, that any kind of fee that you would pay, are given back to the members in the form of lower rates throughout all of your opportunities here. Our board members are also volunteer. They are not paid. They have separate entity jobs that they do, or some of them are even retired. Banks they do profit off any fees that you pay, and they have shareholders, which means the big man upstairs is making money off of you every single time you pay a fee. And their board members are also paid. And then we have the National Credit Union Association versus the FDIC. So we have different opportunities there as a credit union of protection overall. So those are two different entities as well. Laura, do you have anything to add? People should know about credit unions versus banks.
Credit unions are member owned. So
Yes.
I think that's probably the most important thing, that as a member of a credit union, you actually have ownership in that credit union. Banks, as you've mentioned, they are for profit. They have multiple shareholders that they are obligated to report earnings to and then distribute earnings to them. So their objectives are very different from a credit union's.
They want to make money. We want to help people and keep those rates low. So that's a big difference there. So we're going to dive into types of lending, and we're going to break down each of these individually. So our first section is going to be talking about consumer lending. We're going to talk about personal loans, home equity loans, home equity line of credit, and auto loans. Those are your consumer lending categories. And then I'm going to have Laura briefly touch on business lending, also known as commercial lending, for small or large business loans. So Laura, do you have anything to add for business lending?
Not at this time. Do you want me to discuss what that is, or?
Yeah. Business lending is
Sure.
going to be your area of expertise.
Yeah, business lending is when a business is actually the borrower as opposed to a person. So when, on the consumer side, you as a consumer are applying for credit in your name based on your credit, your income, et cetera. Whereas with a business loan, the business itself actually is the borrower. So we base those credit decisions on the financial stability of that business, the type of business industry that it's in, and the financial strength of said business, as well as looking at the owners of that business, because typically a business has owners, and those owners are typically required to be a guarantor for the debt on behalf of their business.
And Case does offer small and large business loans.
Yeah, that's correct.
Which is great. Okay, so personal consumer loan opportunities. Credit cards, credit unions do offer credit cards just like any other financial institution. Credit cards have a maximum borrowing limit with a minimum payment due each month. You want to make sure that you're keeping, if you're holding a balance, you're keeping it at or below 30% of what your availability is extended to you on that card. Personal loans, loan values range and you have a set monthly payment, which includes interest for the term of the loan. There's seasonal loans such as tax time loans, vacation loans, holiday loans. Anytime that you would need any kind of extended credit for a loan there, we can hopefully help you out. Then there's technology loans. It can be used for any technology purchase. It can be used for a computer, a printer, a game console, whatever technology need that you have. You can go ahead and submit for a technology loan. They're available for 12, 18, or 24-month periods. So before we dive into more, I want to talk about secured versus unsecured loans, just so you guys have an understanding of what the difference is. Secured means the loan is connected to a piece of collateral. So examples like this could be a car or a home. There are other things that we could ask for collateral that are bigger items. With a secured loan, the lender can take possession of the collateral if you don't repay the loan as you have agreed to. An unsecured loan is not protected by any collateral. The most common types of unsecured loans are credit cards, student loans, and personal loans. If you default on a loan, the lender cannot automatically take your property, but you will still be liable for any payment on those loans. So it is important to know that there are other ways of actions versus collateral. Is there anything that I'm missing?
Something to consider with the unsecured loans, as you mentioned, there isn't the ability to take anything from you. However, a lender could choose to sue you. Mm-hmm. They could choose to garnish your wages. They could choose to garnish your bank accounts. So they will come after you for repayment if there is no physical collateral to repossess from you.
Okay, yeah, so you don't get to get off free there. Definitely want to make sure you know the difference between secured and unsecured. We wanted to dive in a little bit more in depth on these personal consumer loans because they are, in every entity, they're going to be a little bit different depending on what financial institution you may seek these loans from. We have pledge loans. So share pledge loans are available with competitive rates for you to borrow using funds you currently have in deposit as collateral. So funds, also known as shares from your savings and or term deposits accounts, may be pledged as security. You'll also continue to earn interest on your accounts with pledge loans. Then there's easy money line of credit. An easy money line of credit is an unsecured personal loan that allows qualified members to access a line of credit up to $50,000. Convenient and easy to obtain, it can be used for any purchase or any purpose, such as an overdraft protection. It is also accessible via an ATM card. An easy money line of credit does report to your credit report, just like any other line of credit would as well, regardless if it is being used. If it is open, it is reported. Do we see a lot of pledge loans, Laura, right now?
Not particularly. I don't think a lot of people really understand the benefit of that. You did mention one of the highlights is that you do still continue to earn interest on your funds that are held in deposit for collateral, but you also are borrowing at a low interest rate because the interest rate on a share pledge loan is typically 2 percentage points above the dividend rate that's going to be paid on those deposits. So if your interest rate or your dividend rate is say 2%, that means your loan rate is going to only be 4%. So it's an easy way to borrow money at a fairly cheap cost.
Okay, that's a good way to explain it.
Mm-hmm.
Okay, so at this time we will break for questions. Remember, you can use that Q&A feature if you have anything. You can drop those questions in at any time, and we will make sure to answer them as we go along.
We did have one come in. It says, is there a certain period of time on secured loans or a number of payments where a loan becomes behind that the collateral becomes repossessed?
That is a good question. And that I'll say that depends, but typically a repossession might begin after 90 days. That's not always, it can be sooner. Anytime you are in default of payment, you run the risk of having that collateral repossessed. But typically that would be after 90 days. That's also true, say, with an unsecured loan. If we haven't received payment in 90 days, you will be subject to typically a charge off, which is where we write your loan off our books as a loss. Any other questions?
We're not seeing any at this time, so we'll move forward again. You can ask those questions at any time and we will get to the answers in a minute. Okay, well, we're gonna move on to auto loans. Here at the credit union, we do offer auto loans of new and used. We also have a maximum term of 84 months. Auto loans come in and they are, each individual one is assessed depending on your situation, depending on your credit, depending on your income. There's so many variables when it comes to being accepted for any type of loan, but especially an auto loan. But I also want to talk about responsible rides at Case Credit Union. We have a very unique program here that allows affordable loan payments to those who need a vehicle but cannot get one due to either past credit history, lower income, etc. We're here for you. We are a low income designated credit union, so that means that we can help you. This loan is intended for the purchase of an older, higher mileage vehicles. We do have a lot of great opportunities with responsible rides. We will move on to mortgages. So mortgages, conventional loans. So they are not insured through the US government and can be fixed or adjustable. Rates loans are based on credit worthiness. Your credit will play a lot into any type of loan, but especially when you come to your mortgage. FHA loans, government insured, typically required through first-time home buyers. This is a very popular loan for us as a credit union. We also offer VA loans. They're available to veterans and military families. And then we have rural development loans meant to help households with modest means to get access to housing in less densely populated parts of the country. We have terms of 10, 15, 20, and 30 years available, and appraisal required to ensure the value of the home. Is there anything else for the mortgages you would like to share?
That's a good overview. We do have a variety of programs that you've mentioned, and the credit union is an excellent lender when it comes to mortgage lending. We even have programs that are available to individuals at 0% down in some instances. So if you are interested in a mortgage, you would do well to contact our mortgage department for more information.
Yes. And you're welcome. If you would like more information, you can go ahead and email me or drop your information privately to one of us, and we will make sure to get you over to the right person. You have a great mortgage department here at Case. Home equity line of credit. I'm hoping Laura can back me up on this one. I'm learning about HELOCs every single day. That's what they're called inside the credit union. It's a revolving line of credit that allows you to borrow money against your home, often used for home improvement projects, or even if you just need more money. And you can withdraw as needed instead of in one lump sum, which is kind of a great opportunity there. When do we typically see HELOCs, Laura, outside of those times? Oh, you're on mute. Sorry.
Oh, a HELOC is typically available to an individual who has a reasonable amount of equity in their home. Meaning, let's say a home is worth $100,000 and you owe only $50,000, then you have $50,000 available and possible equity, but we will typically loan up to say 80, 90, or 90% of that available equity. And then we could assign you a line of credit that is available to you for 10 years to draw on. And then at the end of that 10 years, you go into repayment of whatever that balance is that might be at the end of the 10 years, and you would make installment loans over the next 15 years to pay it off.
So taking a home equity line of credit is something that should not be taken lightly. You want to make sure that that need is there, because it is a long-term commitment.
And it is a lien against your home, so keep that in mind.
Let's talk about credit cards with a credit union. So this is one of those things that, as we talked about credit unions versus banks earlier, we want to make sure that you guys are understanding your lending opportunities and when it comes to credit cards and what the differences are between the financial institutions. So we, as a credit union, we are protected by the NCUA, and they kind of regulate all of our interest rate percentages. We wanted to share this with you guys that credit union credit cards often have lower interest rates, lower fees, and are more consumer friendly than credit cards from most major credit card issuers. Interest rates on credit union loans are currently capped at 18%. The source was thebalance.com here. We get a lot of great information for them. But it also goes on to say that for non-credit union credit card issuers, you can see rates up to, or even possibly sometimes higher, 29.99%. Again, this is always going to change depending on the industry. But if you look at the difference just in credit cards, that is a huge win for credit unions. We have, some really low interest rates that we're able to offer membership. Okay, at this time we will break for questions. It looks like we had a few come in over the last couple of slides. So we'll see what we have.
First one we have is, we mentioned earlier in the webinar that if a member or a customer is working to improve their credit score, what would the process look like for someone that is looking to improve their credit score? What would you recommend them starting with? Would it be like a financial counseling appointment?
Yes, absolutely. One of the biggest things that if you're somebody who is not super educated on where to start, we offer free financial counseling here at Case Credit Union, where you don't have to be a member. You can come in and sit down for credit or budget counseling as often as needed. We do talk about this towards the end of the webinar, but yes, financial counseling is a great resource to see, where you need to start to rebuild that credit.
Next question is kind of a two-parter. Do we do loans on homes purchased outside of Michigan?
We do not.
Okay, but if somebody is interested in talking to somebody at the credit union about mortgages, where should they start?
Dan Lynch is our mortgage loan officer, and if you go on our website, there's actually a link and information about contacting him specifically.
I will drop that link into the chat for everybody in the webinar to see as well.
Thank you. Thanks. We have a lot of great mortgage opportunities. Okay, as there are no other questions at this time, we will continue to move forward. We might have had something else come through before we move on.
Is there a process for purchasing a vehicle that is located outside of Michigan, but the lender resides in Michigan? If so, what states are acceptable and which are not?
If you are in Michigan, you can borrow from outside of the state of Michigan, but it would be important for you prior to making that type of a purchase to do your due diligence and make sure that the car exists. There's a lot of scams out there right now regarding purchasing things from out of state, but we do offer financing for out of state auto. If you're purchasing the vehicle from out of the state of Michigan, that is an option, but it would be on your in your best interest for you to do your due diligence, verifying the value of the vehicle, who the actual owner of the vehicle is, getting that vehicle identification number, finding out all the options about that vehicle so that you can determine the value to make sure that the price that's being offered is reasonable, etc.
We did have two more pop in. If someone is working to improve their credit, should they wait to purchase a home?
I would, because one of the things that is first done when an application is submitted is the day you submit an application, if you do it online, we actually do pull your credit report, and we do what we call a tri-merge, which is where we look at all three credit bureaus, TransUnion, Experian, and Equifax, and then we take the middle score of the three. So if you are knowing that you are in the market or will be soon in the market for purchasing a home, I absolutely recommend that you would want to improve your credit score first, because you want to get the best interest rate you can. And so Olivia already mentioned that we do base your interest rate in part on your credit score. So it's extremely important that you have a strong score before you apply.
And the last question I saw come in is, how long would you have to own your home prior to applying and obtaining a HELOC?
It can be done simultaneously with the purchase. If you just happen to have equity in that home, day one, it's possible to close on a first mortgage and a HELOC simultaneously. So there is no timeline. As long as we have a appraisal that we would have to acquire, that would be a fee that would be paid by the person applying. But as long as we have that appraisal that determines the value of the property and that there is sufficient equity available, you can definitely get a HELOC right away.
Got one more, sorry guys, before we move on.
Mhm.
Does CASE offer loans for land or lots? If so, what is the process for a land or lot loan?
Are we talking about for a mortgage or is that for business? I guess I kind of need to know a little bit more. I'll just give a generic answer. Typically, we do not, if it's on the business side of things, because land in itself does not earn income. And typically when we lend on land, the land or the object that we're lending against needs to be able to generate income. So we typically don't do that. Were there any other questions?
I'm not seeing any pop up right now. I think we can move forward. Thank you.
Okay. We'll move forward again, drop them in the Q&A, and I think we have one more break before the end. So let's break down interest rates. Interest rate is the amount charged expressed as a percentage of principal by the lender to a borrower for the use of assets. Interest rates are typically noted on an annual basis, also known as the annual percentage rate, APR. Your credit score and credit history factor into your loan approval and your interest rate amount. It is very important that you know what factors in when you before you set that dotted line for an interest rate. Every time you accept an interest rate, it's going to vary depending on what kind of loan you're taking, what kind of income you potentially have with your credit score, credit history. There's a lot of stuff that goes into interest rates. So we want to make sure that you're understanding before you sign that dotted line. So with that, let's break down a little bit about APR. So APR stands for annual percentage rate and is an annualized representation of your interest rate. This is not something you see on a month-to-month basis sometimes, depending on how you receive statements. So let's break down APR is a combination of your interest rate, points, your mortgage broker fees, and other charges. So APRs, they're kind of complicated. Laura, do you have any insight of how to better explain for somebody who may not be well educated?
Sure. When I think about interest, I think of that as this is what the credit union, bank, whatever, whomever is going to charge you to borrow their monies. So the interest rate is typically, as you mentioned, determined in part by the type of collateral, say an auto loan versus an unsecured loan, or a home loan, or it's also, and then again, it's also based on your credit score. So that interest rate is an annualized, it's a representation of the annualized cost of you borrowing the monies. And you mentioned that there's points and mortgage broker fees. That's not always applicable, but if there were such fees, that could be calculated into that APR that would be given to you. You know, because of course, like with a credit card, there are no points or mortgage broker fees, but it's still that interest that's going to be charged to you to borrow or to use that line of credit, to borrow or to purchase that car, to borrow or to purchase a home. So it's how the financial institution, another way to look at it, how they make their money when they lend money to you.
Thank you for that insight. I realize that as I put this graphic on there, it does not pertain to all. So yes, you're not always going to have mortgage broker fees on every loan, but thank you for explaining that for us. Let's talk a little bit about loan calculators. So I put in a screenshot of our website, kcu.org/online calculators. If you are somebody who is possibly considering taking a loan, you're unsure if you can afford said loan, you're not sure, you're kind of guesstimating on where you're going to be, we have a loan calculator for almost every situation, which is fantastic. So again, this is on our website. You can talk about, you know, auto loans. You can see if you want to do dealer financing versus, you know, credit union financing. We can talk about compound savings, whatever that calculator may need to be, it's there. And that's completely free. You do not need to be a member to access this page. Let's talk a little bit about the impacts of interest. So you are responsible for any interest that is associated with any type of loan. Keeping a balance on a credit card results in paying continued interest each month until there is a zero balance. Okay, you're paying extra money to hold a balance. Credit card statements can often contain how much you will pay in interest over time if you continue to carry that balance. That is a great way of resource, whether you receive your statements online or in the mail. They will tell you if you continue to hold this balance, it will take you a certain amount of time to pay it off, and you will pay this much in interest. If you have a high interest credit card, it is really important that you pay those down as soon as possible to make sure you are avoiding any extra fees that you don't need to be paying. So let's talk a little bit about what impacts your score. Now, every financial institution uses a little bit of a different scoring model. So this isn't 100% the same for every single person, but this is a really good outline, a really good place to start when you need to realize and understand what exactly affects your credit score. So one of the biggest parts of your credit score is going to be your payment history, which weighs between 30 and 35%, depending on your scoring model. And the first thing any financial institution wants to know is whether you've paid past credit accounts on time. How often are you late on those credit card payments? How often are you late on any other loans that you have? Are you constantly on time? The longer your credit history and your payment history, the better it's going to impact your credit score. The amounts owed weighs about 30%. So this is amounts owed through all of your lending options there, the lending opportunities. So whether it's credit cards, personal loans, auto loans, mortgages, all of your accounts and amounts owed are going to be listed there. And that weighs about 30% of your score. And then your length of credit history. How long have you been establishing credit? The longer your credit history, the greater the impact and positivity, hopefully, on your credit score, as long as that credit history is in good standing. Then we talk about credit mix and use. So we want to see a variety of credit. A variety of credit can range from credit cards, personal loans, mortgages, auto. One of the biggest things that we want you to realize that you don't want to be stuck in a situation where you have multiple credit cards, especially if you don't want to carry multiple store cards and only have store cards, because what happens in a situation where you need to have another lending opportunity, whether it's outside of store card and you need to charge something and you don't have that availability to you. So you want to make sure if you're going to somebody who has multiple credit cards, they're not all store cards, but you also don't want to have just one type of credit. We want to see a variety of payments and loan opportunities there. And then new lines of credit. When you open a new line of credit, your credit score will take a little bit of a ding because we are offering an extension of credit to you. So that is about 10% of your credit score. Let's talk about accessing your free credit report. Right now, times are very, very unfortunate, and we want to make sure that everybody understands that they have the right to access their credit report for free. Right now, we have this great opportunity that you can access your credit report for free from all three bureaus every single week. This is through April of 2021. It may possibly get extended. So this is on your screen. You will see that there's 3 steps to follow if you want to fill out and pull your credit report. Now, this will not access your score. It will strictly be your credit report from Experian, Equifax, and TransUnion. You need to log on to www.annualcreditreport.com. If you are searching annual credit report in Google, make sure you bypass the first one that comes up. You'll see the word ad in front of it. We've had a few people reach out recently that don't scroll down far enough. So make sure you're on annualcreditreport.com and not another associated website. You're going to fill out your form to access your credit reports. This should be completely free. They should never ask for payment information. You want to pick the reports that you want, request and review your reports online. It is extremely important that you do this on a secure device, that if you have an option to save on your device or print is going to be a great option for you to hold on to this report and really analyze it and break it down. Make sure you're on a secure form is really where you want to focus on there. Again, we offer free financial counseling. So if you have any questions about accessing your credit report or how to read your credit report, that's why Case is here to help. So this is how you do it for right now. You can pull weekly, which is great. Identity theft is huge right now, and you want to make sure that you are being protected. So tips for success. We want to see you pay all of your accounts on time. We never want to see you make any kind of late payments. That does negatively impact you. Pay credit card balances in full. Try not to carry a balance. If you do carry a balance, keep it at or below 30% of what is lended to you. Review your credit report annually. You can use annualcreditreport.com to pull your report for free up to 3 times a year. This is after April of 2021. You will only be able to access each report once for a single year. So if you pull all 3 at once after April 20 of 21, you have to wait an entire year to pull again. If you're somebody who does not believe you are a victim of identity theft, we always recommend that you pull 1 first. And if you're noticing some indiscrepancies, that's when you would go and pull the other 2 immediately. Or if you pull 1 and you see everything looks correct, you can wait another couple of months. If you're not experiencing any identity theft or don't have any concerns, you can wait a couple months to pull again. You want to budget your expenses and know your due dates. It is really important to make sure that you are on top of all of that. Again, we are here for financial counseling if you need any help with budgeting. And then obviously utilize free financial counseling. It's free, members and non-members. And here's some more information on it. If you're interested in financial counseling, you can go ahead and email me directly. I am a certified financial counselor. We can set you up with an appointment with myself or the 13 others that we have on staff. Or you can log on to www.kcu.org/financial counseling. And there is a form on that website for you to fill out and make sure that you get an appointment with us. Quickly, we'll talk about the Case Credit Union services. We offer checking and savings accounts, online and mobile banking. It's a huge thing right now. It's great, secure. We have a great platform there. We offer auto loans, Visa loans, business accounts, home loans. We talked about all of your lending opportunities that are available with us. So just so you guys know, we offer all of these great services for you. Do we have any questions? I know we're really early today, but that is okay. We got through a lot of information. So we will open it up for questions at this time.
We did have one come in. You were talking about credit scores and how to reach yours. Does pulling your credit report impact your credit score?
It will not negatively impact your credit score as long as you are you're using your annual credit report. It is considered a soft pull on your behalf. So it will not negatively impact you.
We got another one. This is asking whether we really are able to help people when they're trying to repair their credit, or is it just something we do it as a marketing strategy?
No, absolutely. Financial counseling is utilized as often as you need to. We sit down one-on-one with a certified financial counselor. We've gone through a lot of testing and training on everything that we discuss with you. You bring your credit report to us. We give you a list of requirements that we need you to meet. We sit down one-on-one, and we right now everything's being held via Zoom. We break down your credit report and we help you analyze everything and answer any questions you have.
We had another one come in. How do student loans impact your credit? They are not in forbearance, but what's the impact as it relates to paying them off?
Student loans do impact your credits as far as your credit score and relating to paying them off. Yeah, they are all in forbearance right now. So say you were to apply for a loan and we noticed that you had student loans on your credit report. We have to consider that there is a portion of that would go back into repayment at some point. So we would generally calculate a payment estimate to put in your budget so that we can determine your debt to income ratios when we evaluate your request.
If someone, we have another one, if someone goes through a bankruptcy and they did recently receive a unsecured credit card through the credit union, they understand that it takes upwards of 7 years for it to fall off of a credit report, but how long does it take before they start to see the score make progress and start to see that future loans become easier to obtain?
That is a great question. And there is not a black and white answer on that. But I will say, typically, if you have established a new credit card, for example, and you make payments on time, and the idea is that you should utilize that card and pay it off every month in full. Because as Olivia mentioned, some of the key components of a credit score are payment history, being timely, and then also amount available, which is actually looking at credit utilization, meaning how much availability do you have on your lines of credit. So it's crucial and imperative for you to improve your credit score to show a high level of availability on lines of credit, especially post bankruptcy. Credit scores generally can see a reasonable improvement within 6 to 12 months post bankruptcy. I have seen scores post bankruptcy and many instances go back up into the 6 and almost near 700 after a year or so of on time payment history and reasonable utilization of lines of credit. So it is possible. It does take time, but it does happen if you use your credit correctly.
Okay, well, thank you everyone for joining us today. If you have any questions after this webinar, my email is on the screen. Go ahead and send me an email. If I cannot personally answer it, I will make sure to get you over to the right person. Have a great rest of your day.